Hello traders, so welcome to another YouTube video. So if you're new here, I want to welcome you. Welcome to this video. Thank you for clicking. So in today's video, I'm going to actually showcase a strategy, a trading strategy that I've been using for quite some time. So in this strategy, I'm going to show you exactly how you can formulate a setup, especially if you are a day trader. This is a very good strategy for you. So actually this strategy, I'm going to outline a step-by-step process in which you are going to learn how you can formulate a day trade setup, which you can actually get about 40 pips. 30 to 40 pips is very doable in this strategy. So as you can see, I have a monthly chart of the EURUSD. So the first step I'm going to show you is how you can determine your weekly and daily direction. So this strategy actually is very crucial that you must know the daily and weekly direction first, or the daily bias or weekly bias, before you even engage in the other steps. So the first step is the most important and most crucial for you to understand. So I'm going to show you exactly how you can do it. So watch till the end of the video so that you can learn exactly how you can come up with the setup based on this process. So the first thing we're looking at is the monthly chart. So I'll be using the EURUSD in this example. So I'll be showcasing about 2 examples of setups, so you can go back to your charts and follow the entire process the way I'll outline, so that you can also, whichever pair you're trading, you can also formulate setups from them. So when looking at this monthly chart, what I want to look at is just the month of May. So this month of May 2023 is the month we're going to be focused on. So when looking at this monthly candle, as you can see in hindsight, the monthly candle has been bearish. So essentially, what I'm trying to instigate is, do you know the weekly and the daily direction first? So if you know the daily and weekly direction, maybe for example, if you know that in the next 2 or so weeks, maybe 2 to 3 weeks, the market is likely to go lower. So once you know that, then it means every single day of those 3 weeks, you'll be hunting for this setup. So in this monthly candle, we actually had a bearish month. And the reason we are bearish is because we had hit this is an imbalance in the monthly chart, which was our target. Once there's a movement that was coming down from here, there's a imbalance down here that brought this market all the way up here. And once we hit this imbalance, we got this reaction. So we'll be looking at the daily chart, how we could have anticipated such a move in the month of May, and even on the weekly chart. So the monthly doesn't really give us much information, but when we drop to the weekly and the daily chart, you'll begin to understand how we can break down and know exactly which direction to focus on either in the month or in the next 2 to 3 weeks. So let's drop to the weekly chart so that we can begin to break down everything in terms of direction and in terms of bias. So we have dropped down into the weekly chart on the EURUSD. So that same imbalance that we are watching on the monthly chart, this is the same imbalance. So as you can see, actually when you zoom in, as you can see, there was a time when the market attempted to get into that imbalance, but I think maybe if you can see from this perspective, there's a time the market attempted to get to that imbalance, but it failed, and then it started dropping. But as long as we have not hit that objective, as long as we have not hit any relevant level, I was still watching for that level to be hit. So once we retraced, we came back and then hit that level. So the reason actually we were bearish in the month of May, this is the main reason. So once we hit this imbalance, we also took out this buy side liquidity. So these are buy stops that were taken out on the weekly chart. So once we hit that imbalance, we took out buy side liquidity. And then once we took out those buy side liquidity, you can see immediately the market, actually after this week, this is the first week of May. There was this first May, and then this is the second week. This is the second week of May. So after the first week of May, we weren't really sure if the market wanted to go lower. But after this week, this was a very clear indication that the market wanted to drop lower. So once we hit this objective and we take out buy side liquidity, you want to see actually the market now starting to slide lower. And if we get this indication, a clear indication, I think on the daily chart we'll get a very clear outlook of exactly where or when we were now clearly bearish. So on the weekly chart, it just seems like it just started dropping, but the buy side liquidity being taken was very crucial on the weekly chart. So once it is taken out and you have this range, you actually typically will be looking at this range first. So the only thing that I outlined on this range was this order block, because this was the only thing that could have stopped this market from maybe when it was coming down low. So there's no imbalance, there's nothing. The only thing we're watching is this order block. So you can actually go to my channel and look at the weekly forex forecast. You can see exactly what we are watching. So even all my students know that we have been watching this order block on the weekly chart, and also on the daily chart we had also some targets that we were watching, which we'll get to once we drop to the daily chart. So essentially, once we take out those buy stops, you want to look at this range between this imbalance and that objective. That is your range of opportunity. So we had about 390 pips range of opportunity between that imbalance and this order block. So that's all you need on the weekly chart. So clearly from this week, essentially this week, we were clear on the direction of the weekly chart. But I'll show you on the daily chart how we could have known even before the week closed bearish, how we could have known from this week that potentially we could be dropping lower into this objective. So let's drop to the daily chart so that we can see exactly what you could have anticipated and what you could have seen, in order for us to know that the daily has shifted and the weekly has shifted, for us to look for lower prices and for us to change our bias to bearish. So let's drop to the daily chart. So when you get to the daily chart, essentially what you want to do is, as you can see, we had that imbalance and we had this buy stops. So these are the same buy stops on the weekly chart that were taken out. But as you can see also, the daily chart had its own buy stops which were taken just within that range of hitting that monthly imbalance. So let's begin on how we could have known early, even before the week ended, how the market was turning. So the first thing I wanted to note is we took out buy side liquidity here. So this run here took out this buy side liquidity. Now, and then we had a long period of consolidation. But the moment the market now came and broke this low, once it took out buy side liquidity, then it came all the way and broke this low. This is a break in market structure. So once we break market structure there, that is a clear indication that the market wants to run for lower to those objectives below. So we will be looking at this as an objective, this lows, and then eventually that target as an objective. So that's how you know that the market has shifted early, even before the week ends or closes. So the moment we took out this low, that is our clear indication that the market is now bearish, and we'll see this run. So this number of days you'll be watching for bearish prices. So that's how you know the daily bias. It's as simple as that. It's not complicated. That's the simplest way I can explain the daily bias and the weekly bias, and it's as simple as that. It's nothing more than that. That's all you need to understand the direction of the week or the month or the days that are coming ahead. Because once you understand that the market is most likely to go lower, then this actually it simplifies your work, because the only thing you'll be doing now on the lower time frame is now to look for lower prices. Anything that is going higher is low probability, but anything that is dropping is high probability. So that's how you determine your daily bias. That's why daily bias is very important, and you need to understand it, because once you understand the daily bias, everything else becomes simple. Everything in the lower time frame, if you go to the 15 minutes chart, 4-hour chart, 1-hour chart, any setup you want to frame, as long as you have understood the general direction of the market, everything becomes simple. As you can see, from the moment we actually broke below up to this low, this is 31st May, so that was the entire month. From the moment we broke below that low, you can actually count the number of bullish days. You have 1 day, 2, 3, 4 days before this low. Only 4 days out of all these days were bullish. So as you can see, the high probability scenario is that you will get lower prices. That is why daily bias is very important, and I cannot insist more on that, because that is the most crucial part of this strategy. So once you understand that, once you get that breaking structure, you're looking for lower prices. So anything that comes back up is just coming back up to continue lower. So we have the second thing you want to do is outline order blocks. So what I like to use order blocks and fair value gaps. Those are the only PDRAs that I like to use. So the first thing, we had this order block which was used. So before that breaking structure, we could have even got an even early indication that the market may drop. We had this order block which was retested here, and then the market started sliding lower and lower and lower. So anything that comes back up is just to continue lower. So that imbalance was a key imbalance to watch. And then once we dropped lower, we had this order block. We continued lower until we hit that target. So those are the only daily order blocks and fair value gaps that were used. We also have a smaller fair value gap in there, which we'll be looking at when it drop to the lower time frames. So also on the 4-hour chart, you want to look at even more PDRAs. So let's drop to the 4-hour chart. Within this range of opportunity, let's look at that 4-hour chart. And as you can see, so actually I'll be outlining two examples as indicated here. When you drop down below now into the 15 minutes chart, this is the same imbalance in the daily chart, and we have a 4-hour order block, mean threshold of the bodies. So I've taken the body and I've split it into half. That's what I've indicated here as the 4-hour order block mean. And then another thing I've done is just outline more PDRAs, so you can also go back to your charts and just study those examples. So I'll be just looking at these two examples and maybe a bullish example right here, but you can go to your charts and look at what happened in the 4-hour order block based on this strategy that I'm going to outline. And then we have a 4-hour imbalance, another 4-hour imbalance right there. When the market is coming back up, it retraces that imbalance, and then we have that order block which we'll be looking at. So that's all I'll be looking at on the 4-hour chart. It's just getting more opportunities within the 4-hour chart. The next thing we're going to do now is drop to the 15 minutes. So this will be the foundation of this strategy. So the main foundation of this strategy is the midnight open. So when you drop down to the 15 minutes, we'll be outlining the midnight open on each trading day. So each trading day that you want to trade, the first thing you want to do is outline the midnight open. Now when I say the midnight open, I've indicated that it is New York time. So when you go to trading view, when you go to this time zone, when you click that time zone, you'll see a lot of time zones indicated here. But what you want to do is select the New York time zone. So that's what I'll be using in this as the New York open, midnight open. And then I also have an indicator here. You can also go to your trading view and look for this indicator. It's called FXN, week and day separator. So when you drop to the 15 minutes, you'll see exactly how that indicator looks like. So basically those are the tools that we're going to use. I also have another one. It's called ICT kill zone. I think this is the main indicator we're going to be using. Yeah, so this is how it looks like. So make sure you get the right indicator. It's called ICT kill zone, so you can go and search for it in the indicators. So let's drop to the 15 minutes and we can expound more on what we are talking about here. So when you drop to the 15 minutes chart, what I want to do first is the two setups that I've indicated, bearish setups that I've indicated in the 4-hour chart. These are the two setups. So let's look at the first setup. So this is that imbalance on the daily chart that I've already outlined. So what you want to do is actually outline the midnight open. So midnight open is actually, this is the week and day separator. So it will separate for you. This Friday, it will show you Thursday. So between this kill zone, it will show you from midnight to the next day midnight. So in between is just the entire day New York time. So it is very specific time zones, So you want to be actually very specific in your strategy. So the rules are very simple. The best setup. So once you indicate the midnight open, so I've indicated here with a dotted line, we have midnight open. So it's the first candle within that midnight separation. And then what I want to do, I want to show this ICT kill zones. So this ICT kill zones basically is very specific time zones. So I've indicated from 2 a.m. to around 5 a.m., which is the London session. And then this is 7 a.m. to 12. It should be to 12. That is the New York session. And then we also have Asian session. So what we are going to be using mainly is the London and the New York session. And the time that we are going to be looking for this setup, and essentially by 12 p.m. New York time, you want to have maximized on that setup, and anything beyond 12 p.m. is very low probability, and I do not look at setups beyond 12 p.m. So this is very time specific. I like to look at setup between 2 a.m. New York time and 12 p.m. New York time. So those are the time you want to focus on. So now let's begin. So outline the midnight open. Once you outline the midnight open, what you want to watch is if you're bearish. Now when I say if you're bearish, I mean that you've gotten that the weekly and daily direction is bearish based on what I've shown you on the weekly chart and the daily chart. Now if you're bearish, you want this market, actually you want to see the market come above midnight open. So that is the core principle of this setup. You want to see the market come above midnight open, but it's not just coming above midnight open. You also want to see it take out buy stops, buy side liquidity within that intraday, within this day. You want to see it take out buy stops, and you also want it to see either hit a daily imbalance or order block or a 4-hour imbalance or order block. So in this example, we have this daily imbalance which was hit. So as you can see, the market came and hit that imbalance and it took out buy stops. And then immediately once it takes out buy stops and hits that imbalance, what you want to look out for now. Now listen very carefully. This is what you want to look out for. Once you have that stop run, you want to look for a break in market structure. So I've focused on the 15 minutes, but we'll also be looking at an example on the 5 minutes. But essentially it's just we'll be opening up and seeing what was going on in the 5 minutes. So this low here, once it was broken, that is now the break in market structure. So that is very key. Once you see that break in structure after hitting that key level, and then it leaves an imbalance. So I like to see it actually leave an imbalance, and then the market will come back up. Preferably, you want to see it above midnight open still when you are entering, but not always. Sometimes it will give you an entry near the midnight open. So when it is above midnight open, that is very prime, and you want to enter within that imbalance. As I've indicated here, the entry was just at the imbalance, and my stop loss comes above this highs. You cannot even place it above the imbalance. You don't want to see this order block being taken out. So essentially your stop could come here, but I like to put it above the high because sometimes it might spike because of news. So above the high should not be taken out. And then now once you have that, you just target the lows on the previous day's lows. Not always will it get to the lows, but what I like to do, I like to target between 30 to 40 pips. That is what I've seen consistently delivering every single week, every single day using this setup. 30 to 40 pips is very achievable, especially when you take your entry above midnight open. So that's the first example. So as you can see, you get about 2.5 R. You get a stop loss of about 16 pips and a target of 41 pips. Now, on the second example, we have this 4-hour order block. So this is the 4-hour order block mean. So let's expound on that. So this is the next day, actually. So the market delivered lower, and then it begins to go back up. So this going back up is just seeking this premium level. So when the market now came back up, still within London session or New York, we saw this one was New York session, but this one we are seeing it now. This is the order block mean. It was hit during London session. This is at 2:15 to 30 a.m. Now, yes, as you can see, it went slightly above it, but it was seeking buy-side liquidity. So as I outlined, the most important aspect is also you want to see some form of liquidity being taken out after hitting that key level. So once we hit that key level, we took out buy stops, and the market now started collapsing. So what you look for is that break in structure. So this short-term low is taken out. On the 5 minutes, it will be more clearer. And again, all happening above midnight open. So your entry comes there, and then right there, and then you stop above that high, and then you aim for 30 to 40 pips. So as you can see, this day we did not take out this low. Clearly you can see we did not take out this lows, but we achieved at least 30 pips. So by the time it reaches 12 p.m. you want to be out of that market, because usually from 12 p.m. as you can see in this example, the market will start rallying against you because it has completed its daily objective. Sometimes it might go lower, but majority of the time I've seen 12 p.m. to be the benchmark for you to take your stops, to take your profits, and just be out of the market. So if your take profits has not been hit, you can manually take out your profits and just stay out of the market, because from 12 p.m. the market may enter into a program of retracement. So that is it about this setup. That's how it looks on the 15 minutes chart. So as you can see, this stop loss was 7 pips and you achieved about 30 pips. So that is how it looks like. Finally, I can look at a bullish example. So let's look at a bullish example which happened recently. So assuming you have analyzed your charts and you've seen that the daily and weekly bias, daily or weekly bias is bullish. So the same way we outlined, or we looked at the bearish example, is the same way you can look at this bullish example. So assuming you have analyzed your chart and you've seen that the market is bullish, then you want to outline that midnight open. The market went initially lower below midnight open to seek some form of discount. So I've not indicated here what it hit, but on the previous day it had hit order block mean of the order block on the daily chart, and then it started rallying higher. So anyway, this is just an example of the midnight open, and because as you can see, once we broke this structure here, the market rallied higher and it came back down just specifically to hit that midnight open for the entry right there, and then it started rallying. As you can see, I've outlined the example here. It's 25. This was a bit wide. It's about 25 pips, but you can also place it just here. And then you target those highs. So that is how you can sorry about that. So that's how you can actually look at that setup on the bullish example. So that's the bullish example of that setup. So I think we can drop into the 5 minutes chart to look at what was going on within this setup. So let's drop to the 5 minutes chart, and then we can look at an example of how the 5 minutes chart looks like. So the 5 minutes chart, let's look at that. Sorry about that, I just got a call. So let's, as you can see, this 5 minutes chart, this is the same area where we hit that imbalance on the daily chart. So as you can see, we had a lot of short-term lows that were taken out aggressively. So from that high, we saw this market drop aggressively and take out all these short-term lows. On the 15 minutes, it looked like it was just one low, and then immediately we saw that retest. So your entry should come inside that imbalance, or rather just on the retracement within that place where the market broke structure. So our entry was around that level, and then dropped lower aggressively. The same way we saw on the next day. Actually, this was even a clear example. We saw once we broke above and then now broke below, took out all these short-term lows. So you have this short-term low, we have another one here. So aggressively the market took them out at once and then it retraced back. So this retracement, as the market is going higher, that is your entry right there, and then you target 30 to 40 pips and you're done. So that is the heart of that strategy. So as you can see, it's a simple strategy, it's a straightforward strategy. So there's nothing much about this strategy, that's it. So you can go to your charts and study this strategy. I believe you'll find it very useful in your trading. And I know that this strategy is very high probability because you're entering in a very prime market that is really very willing to move on the opposite direction, especially when you take all the rules that I've outlined here and you go with them. So that is it about that trading strategy. It's mostly about the midnight open, and I also teach this strategy, but I break it down even more and I outline it more in my trading course. You can check out my trading course in my website, which I'll be providing the link in the description below. So just go to my website, thepricetrader.com, and you can see the course outline. I've outlined everything there. I teach everything from midnight open, from the day which you need to trade, the time which you need to trade, everything that you need to do in order to be a successful trader. You'll find it there. I also teach about money management, psychology, everything. Essentially, you become an all-round trader when you go through the course. So it's an online course. You can do it at your own pace. We also offer one-on-one training. You can also enroll in that if you wish. So you can choose between the online course or the one-on-one training depending on your needs, depending on the time you have, on the pace you want to take your learning, and also depending on how available you are. So essentially you're free to choose between. So that's why I'm offering both sides, because I know not everybody has the time to learn on a one-on-one basis. I also offer online course. So check it out, and if you're willing, you can join my trading community, you can join my students, and we learn from each other, and you can actually learn a lot of things. So thank you so much for watching this video. I'll see you in the next video. Thank you. Thank you so much, guys, for watching. I hope this video has been helpful. If you enjoyed this video, don't forget to like, subscribe, and comment. Also, let me know what kind of content you want to see or any suggestions you have. Thank you.